Hey everyone! With BlockSonic, you get the top Bitcoin news of the day in a practical, narrated format, so you never miss an important market move. With BlockSonic, you don't need to search for information, we find it for you. This metric suggests Bitcoin's late November plunge was the bottom and major upside lies ahead. Extreme readings in the ratio between short-term holder supply and profit and short-term holder supply and loss have aligned with the end of bear markets. By James Van. As Bitcoin tumbled in late November to nearly $80,000, the ratio between short-term holder supply and profit and short-term holder supply and loss fell to levels that have historically coincided with major or local bear market bottoms. On November 24, the ratio declined to 0.013. Each previous instance of the ratio reaching this level has marked either a local bottom or the definitive bear market low, including in 2011, 2015, 2018 and 2022, according to Glassnode data. Glassnode defines short-term holders as investors who have held Bitcoin for less than 155 days. At the November trough, the 7-day moving average of short-term holder supply and profit fell to approximately 30,000 Bitcoin. In contrast, short-term holder supply and loss surged to 2.45 million Bitcoin, the highest level since the FTX collapse in November 2022, when Bitcoin bottomed near $15,000. Since the start of 2026, Bitcoin has rallied to about $94,000, a jump of over 7%. Over this period, short-term holder supply and loss has declined to 1.9 million Bitcoin, while short-term holder supply and profit has rebounded sharply to 850,000 Bitcoin, a ratio of roughly 0.45. Historically, when the ratio approaches 1, it tends to move above it and continue expanding beyond that. The price of Bitcoin tends to enter a sustained upside phase at the same time. With the ratio currently sitting below 0.5%, the metric suggests there remains room for significant further expansion before reaching equilibrium. As for tops, they've tended not to occur until the ratio rises toward 100. Morgan Stanley files for Bitcoin and Solana ETFs, deepening crypto push. Wall Street heavyweight files for Bitcoin Trust amid rising institutional demand. By James Van. Morgan Stanley has filed with the Securities and Exchange Commission, SEC, to launch a spot Bitcoin exchange-traded fund, ETF, and Solana Trust, pushing its digital assets ambitions further. The Bitcoin product, called the Morgan Stanley Bitcoin Trust, is structured as an exchange-traded fund designed to track the price of Bitcoin, net of fees and expenses, according to a Form S-1 submitted on January 6. If approved, the fund's shares are expected to list on a national securities exchange under a ticker symbol that has not yet been disclosed. The Bitcoin Trust is sponsored by Morgan Stanley Investment Management and will hold Bitcoin directly rather than using derivatives or leverage. Its net asset value will be calculated daily using a designated Bitcoin pricing benchmark derived from activity on major spot exchanges. The fund will be passive and will not attempt to trade Bitcoin based on market conditions. Shares will be created and redeemed only in large blocks by authorized participants, either in cash or in kind. Cash transactions will be executed through third-party Bitcoin counterparties selected by the sponsor. Retail investors will be able to buy and sell shares on the secondary market through brokerage accounts. Morgan Stanley's filing follows the rapid expansion of spot Bitcoin ETFs in the U.S. market over the past 2 years. Soso Value data shows these now have $123 billion in total net assets, equivalent to 6.57% of Bitcoin's total market capitalization. Since the start of the year, net inflows to these products have topped $1.1 billion. Morgan Stanley has also filed a Form S-1 with the SEC for the Morgan Stanley Solana Trust, meant to track the price of Solana. These funds, as data shows, have grown to more than $1 billion in total net assets, following a total cumulative net inflow of nearly $800 million. The filings show Morgan Stanley shifting from simply distributing third-party crypto products to building its own in-house vehicles, signaling a deeper, higher conviction commitment to digital assets. This pivot is likely driven by the robust economics of the ETF and trust business, underscored by the substantial fee revenue traditional finance firms have generated from spot Bitcoin products in a short period. For example, BlackRock's spot Bitcoin ETFs became the firm's top revenue source in November of last year, according to BlackRock Brazil's Director of Business Development, Cristiano Castro, with allocations nearing $100 billion. Unlike asset managers such as BlackRock, Morgan Stanley operates a massive wealth management arm with thousands of advisors that opened crypto access to clients in October last year. By leveraging its own ETFs, the bank can vertically integrate these products into its client portfolios, keeping management fees in-house rather than paying them to competitors. If you believe in what we're doing and want to support BlockSonic's growth, just scan the QR code on the screen or copy the link in the video description. Every contribution makes a difference and helps us keep delivering quality, independent, and up-to-date content for you. Largest Bitcoin ETF inflow in 3 months signals institutional bid is back. Strong institutional demand returns as flows turn positive and Bitcoin price recovers. By James Van. Bitcoin exchange-traded funds, ETFs, in the U.S. registered their largest daily inflows since October 7 at $697.2 million on Monday, according to Farside data. U.S. ETFs have recorded approximately $1.2 billion in net inflows across the first 2 trading days of 2026, coinciding with Bitcoin rising nearly 7% from $87,000 at the start of the year to slightly under $94,000. Since spot Bitcoin ETFs first listed in the U.S. in January 2024, extended periods of outflows have typically aligned with local market bottoms, based on a 30-day moving average, according to Glassnode data. Notable examples include August 2024 during the yen carry trade unwind, when Bitcoin fell to roughly $49,000, and April 2025 amid the tariff tantrum, which marked a local low near $76,000. Outflows began in October 2025 but are now flipping back into positive territory. This shift is further supported by the Coinbase Premium Index, which has climbed back towards slightly negative levels, indicating conditions are no longer consistent with capitulation. Copper, gold, and Bitcoin, a macro signal to watch. The copper-to-gold ratio is breaking higher, a move that has historically aligned with key turning points in Bitcoin cycles. By James Van. The copper-to-gold ratio is widely followed as a macro indicator of economic momentum and investor risk appetite. Historically, it has shown a notable relationship with Bitcoin, according to Super Bitcoin Bro. Copper is heavily tied to industrial demand and tends to perform well during periods of economic expansion. Gold, in contrast, is a defensive asset that typically outperforms during periods of greater uncertainty and slower growth. When the ratio between the two is rising, it signals a risk-on environment, while a falling ratio points to risk aversion. Major peaks in the ratio, seen in 2013, 2017 and 2021, have coincided with cycle highs in Bitcoin prices. These periods reflected strong global growth expectations and elevated speculative risk-taking across assets. More importantly for Bitcoin, however, has been the behavior of the ratio after prolonged declines. A reversal in the ratio has often preceded significant Bitcoin rallies, particularly when they align with Bitcoin halving cycles. Bitcoin halvings, which reduce the payout to miners by 50%, occur roughly every 4 years and tighten supply. Historically, they have acted as a catalyst for longer-term bull markets. During the 4th Bitcoin halving, in April 2024, the copper-to-gold ratio was still dropping. That dynamic has since shifted. The ratio now sits near 0.00136 after bottoming in October around 0.00116. At the same time, copper prices are pushing through $6 per pound at all-time highs, while gold trades near $4,455 per ounce, also close to its record. Over the past 3 months, copper has gained 18% and gold 14%. If copper's strength reflects improving growth expectations rather than purely supply constraints, the resulting risk on signal could support a Bitcoin rally in 2026. And don't forget to subscribe to the channel, leave a like, share it with your friends, and join the chat. These simple actions really help the project grow and keep BlockSonic running strong every day. XRP's 9% surge leads crypto as Bitcoin climbs to 6-week high near $95,000. By Helene Braun. Bitcoin rose to its highest level since mid-November, gaining more than 3% to $94,400 during Monday's trading session, the largest percentage advance in more than a month. The rally, which brought the asset closer to $95,000, seen by some analysts as a key level to gain further momentum, was led, though, by. After breaking key resistance overnight, XRP added to its move during the U.S. trading day, rising 9% to just shy of $2.32, also the strongest since mid-November. Crypto-related stocks, many of which saw unrelenting selling late in 2025, were sharply higher across the board. Coinbase, Coin, which received an upgrade to buy from Goldman Sachs earlier in the day, was up nearly 9% while Strategy, MSTR, and Robinhood, Hood, rose 5% and 6%, respectively. Among some smaller names, Bakkt, BKKT, flew 30% higher, while Figure, FIGR, added 20%. Bitcoin miner Hut 8, HUT, whose pivot to AI infrastructure paved the way for a significant advance in 2025, was up 15% on Monday, nearly reaching $60 per share. Long-time investors might have the stock's split-adjusted 2021 record high of $76 in their sights. U.S. stocks are also higher on Monday, led by the Dow's 1.4% advance. The Nasdaq and S&P 500 are up a more modest 0.7%. Precious metals remain volatile, with a notable upward trend. Silver is ahead 7% and gold 3%. Bitcoin, which fell more than 6% in 2025, may be poised for a comeback in 2026, according to Lukman Otunyiga, senior market analyst at FXTM. After a challenging 2025, falling interest rates and a thinning supply of actively traded Bitcoin could create conditions for a recovery, he said, pointing to long-term holders keeping coins off exchanges as a factor that may tighten supply and support prices. Still, he warns of several headwinds. New tax reporting requirements in the U.S. could dampen retail participation, and regulatory decisions targeting crypto-heavy firms remain a risk. On the technical side, Otunyiga says a sustained move above $100,000 could revive record-high ambitions, while a drop below that threshold could leave Bitcoin vulnerable to deeper declines, with support levels near $77,500 and $54,000. Tom Lee calls for new Bitcoin record in January, while warning of a volatile 2026. The Fundstrat co-founder and Bitmine chair said Bitcoin has yet to peak in January and reiterated his belief that Ether is dramatically undervalued. By Olivier Acuna. Fundstrat Global Advisors co-founder Tom Lee said Monday Bitcoin has not yet peaked and could reach a new all-time high as soon as this month, doubling down on a bullish crypto and equity outlook during a CNBC Squawk Box appearance. "I don't think Bitcoin has peaked yet," Lee said. "We were overly optimistic about achieving the high watermark before December, but I do believe that Bitcoin can hit a new all-time high by the end of January 2026. So, we should not assume that the prices of Bitcoin, Ethereum, or other cryptocurrencies have already peaked." The call comes after a late 2025 pullback across digital assets and positions January as a potential breakout month, a notable escalation in Lee's long-running crypto bull case. In August, Lee predicted Bitcoin would surpass $200,000 before the end of last year. Bitcoin ultimately hit an all-time high north of $126,000 in October, well below Lee's prediction, and traded at around $88,500 on December 31, 2025, according to CoinDesk data. Lee predicted 2026 will be a volatile but ultimately constructive year for crypto markets. However, he warned of near-term turbulence driven by institutional repositioning before a stronger second half. 2026 is going to be a year of two halves. The first half of 2026 may be tough as we deal with institutional rebalancing and a strategic reset in the crypto markets, but that volatility is exactly what sets the stage for the massive rally we expect in the back half, he said. According to Lee, the reset is not a sign of structural weakness but rather a digestion phase following multiple years of outsized gains across risk assets. Lee was especially bullish on Ether, arguing that the asset is entering a multi-year expansion phase reminiscent of Bitcoin's 2017 to 2021 run. Last year, he said Ether would hit an all-time high of $15,000 by December. This prediction was also a miss. The cryptocurrency's highest price in 2025 was $4,830, and it traded at roughly $3,300 in December. In Monday's appearance, he demonstrated his continued bullish Ethereum stance, with his crypto mining firm Bitmine Immersion Technologies acquiring more Ether. It now holds 4.14 million. Our belief is that Ethereum is dramatically undervalued, Lee said. We believe Ethereum is entering a supercycle similar to Bitcoin from 2017 to 2021. He framed Ethereum exposure as a balance sheet imperative rather than a speculative bet. Acquiring an asset that can appreciate by 10 times or more is a strategic necessity for any modern treasury, Lee said. Beyond crypto, Lee outlined one of Wall Street's most aggressive equity forecasts, projecting the S&P 500 to reach 7,700 by the end of 2026 on the back of resilient corporate earnings. If you look at the fundamental strength of the U.S. economy and the AI-driven productivity gains, we are looking at a path to S&P 7,700 by year-end 2026, Lee said. This is supported by an EPS story that is far more resilient than the bears are giving it credit for. Still, Lee framed any pullbacks as opportunity rather than warning. There's a lot to be optimistic about in 2026. Update, January 5, 2026, 18:05 Universal Time Coordinated adds additional detail, corrects Bitcoin's all-time high price. And don't forget to subscribe to the channel, leave a like, share it with your friends, and join the chat. These simple actions really help the project grow and keep BlockSonic running strong every day. Bitcoin eyes $94,000 as crypto prices manage early U.S. gains for second straight session. By Helene Braun. Crypto prices are kicking off the first Monday of the year with strength as traders rotated back into risk assets following the weekend capture of Venezuela's Nicolas Maduro. For the second consecutive session, crypto is adding to overnight gains during the U.S. trading day, a notable change from late 2025 when the sector consistently pulled back as American stocks traded. Indeed, the Coinbase Bitcoin Premium Index has climbed sharply in the first week of 2026, signaling a rebound in U.S. demand. The gauge had fallen to its lowest level in 9 months on January 1, when Bitcoin was trading around $88,000, registering a reading of -0.018%. The index measures the price difference between Bitcoin traded on Coinbase, a leading U.S. exchange, and the global market average, and is widely viewed as a proxy for U.S. capital flows, institutional activity, and market sentiment. That January 1 reading marked the most negative level since the first quarter of 2025, when Bitcoin slid towards $76,000 during the tariff tantrum. A similarly sharp negative print was also recorded in November 2025, coinciding with Bitcoin's local bottom near $80,000. The premium has since improved to around -0.03%, suggesting that U.S. capital flows are starting to return. Rallying nearly 1% since U.S. stocks opened for trade on Monday, Bitcoin has pushed back to nearly $94,000, up 3% over the past 24 hours and to its highest level since the first 10 days of December. Ether and are up similarly, while Solana is ahead just 1%. Down modestly over the past 24 hours is, although it remains 20% higher over the past week, sparking a rush of related ETF inflows. While momentum has shifted from negative to positive after a quiet holiday stretch, the $95,000 mark remains a key level for Bitcoin, according to Jake Ostrowskis, head of OTC at Wintermute. We await the U.S. session to confirm or reject this move, and potentially reverse the late 2025 pattern of U.S. selling, he said, pointing to the fact that Bitcoin dropped a cumulative 5.45% during U.S. hours versus a 10.01% gain during APAC hours. This is worth watching, he said. If Bitcoin and Ether stay above key levels through the U.S. session, systematic buyers could step in and add to the momentum. Thoroughly beaten down in the second half of 2025, digital asset treasury companies, DATs, are posting outsized advances on Monday. Among those higher by double-digit percentages is Strive, ASST, which disclosed the purchase of another 101.8 Bitcoin in the fourth quarter, bringing its total holdings to 7,626 Bitcoin valued at roughly $708 million. American Bitcoin, a Bitcoin, is up 13% after adding 329 Bitcoin, increasing its reserves to 5,427 Bitcoin. Solana-focused DeFi development, DFDV, is higher by 16%. Bitcoin miners continue to face dwindling profits despite lower competition, JP Morgan says. Mining profitability declined last month, with daily block reward revenue down 7% and 32% year-on-year. By Will Canny. And don't forget to subscribe to the channel, leave a like, share it with your friends, and join the chat. These simple actions really help the project grow and keep BlockSonic running strong every day. Strategy boosted Bitcoin holdings and cash reserve last week. The Michael Saylor-led company added 1,287 Bitcoin and $62 million in cash via the sale of common stock. By James Van. Strategy, MSTR, the world's largest publicly traded holder of Bitcoin, in the final days of 2025 and early days of 2026 lifted both its Bitcoin holdings and cash reserve. Led by Executive Chairman Michael Saylor, the company added 1,287 Bitcoin for just over $116 million, or an average price of about $90,000 each. Firm holdings are now 673,783 Bitcoin purchased for $50.55 billion, or an average price of $75,026 each. The company last week also added $62 million to its cash reserves, bringing that total to $2.25 billion. The boosts to both the cash and Bitcoin reserves were funded through the sales of common stock. The cash reserve is intended to fund dividend payments on the company's perpetual preferred equity. At current levels, Strategy has enough cash on hand to fund 32.5 months of dividend coverage, according to the company dashboard. Alongside news of the balance sheet additions, the company disclosed $17.44 billion in unrealized losses on its Bitcoin holdings in the fourth quarter. Not surprising given Bitcoin's decline from the $120,000 area at the start of October to $88,000 to close the year. MSTR shares were up 4.5% in pre-market action alongside a weekend rise in the price of Bitcoin to the current $92,900. Bitcoin's breakout lifts crypto equities and miners in pre-market trading. Bitcoin pushes above $92,000 as stocks tied to crypto, AI mining, and metals rally in pre-market trading. By James Van. Bitcoin-related equities and technology stock futures such as Invesco's QQQ are higher in pre-market trading as Bitcoin has broken above $92,000, briefly touching $93,000 during the Asian morning on Monday. Strategy, MSTR, is up 3.5% to $163 per share and is expected to announce another Bitcoin purchase later on Monday. STRC, the perpetual preferred equity, is approaching par at $100 after the company raised the dividend rate to 11%. While Strive, ASST, another Bitcoin treasury company is up 12%, approaching the $1 level. AI-related miners are also extending gains. Cipher Mining, CIFR, and IREN, are both up more than 2% after rallying as much as 10% and 13% on Friday, lifting their share prices to $17 and $44 respectively. Hive Digital, Hive, is up 6% to $3 per share. Mara Holdings, Mara, is up 3.5% to above $10 per share, while fellow Bitcoin miners Riot Platforms, Riot, and CleanSpark, CLSK, are each up around 3%. Meanwhile, following Venezuela and US-related developments, metals have continued their rally, with gold and silver up 2% and 4% respectively. The DXY index is also slightly higher, approaching 99. And don't forget to subscribe to the channel, leave a like, share it with your friends, and join the chat. These simple actions really help the project grow and keep BlockSonic running strong every day. Bitcoin's squeeze sets stage for major price swing. Bitcoin's volatility bands have compressed to levels that have historically paved the way for a renewed price turbulence. By Omkar Godbole. Bitcoin's price chart looks super calm right now, according to Bollinger Bands, a key volatility gauge, hinting at a massive swing ahead. Bitcoin has traded in a tight range between $85,000 and $90,000 for the past 2 weeks. As a result, the gap between its Bollinger Bands, volatility bands placed 2 standard deviations above and below the 20-day simple moving average of the asset's price, has narrowed to less than $3,500, the lowest since July, according to data source TradingView. This so-called Bollinger Bands squeeze indicates a low volatility period in which the market is building energy for the next big move. History confirms massive price swings often follow these squeezes. For instance, the last Bollinger Band squeeze in late July capped a 2-week sideways grind between $115,000 and $120,000. The squeeze paved the way for a 3-month expansion, with prices swinging wildly from $100,000 to $126,000. A similar pattern unfolded in late February. A range between $94,000 and $98,000 tightened into Bollinger Band squeezes, followed by a slide to $80,000 by month-end. Bollinger Bands have accurately signaled volatility explosions since at least 2018. The latest squeeze, therefore, calls for trader vigilance as prices could soon move rapidly in either direction. The latest squeeze, therefore, calls for trader vigilance, as prices could soon move rapidly in either direction. As of writing, Bitcoin traded around $88,600, up just over 1% on a 24-hour basis. Strategy shares register first 6-month losing streak since adoption of Bitcoin strategy in 2020. Crypto analyst Chris Millis has highlighted an unusually persistent slump in strategy shares, breaking with past drawdown patterns even as the firm continued accumulating Bitcoin. By Siamak Masnavi. Strategy, MSTR, shares have declined for 6 consecutive months for the first time since the firm adopted Bitcoin as a treasury asset in August 2020, according to a performance table shared Thursday by crypto analyst Chris Millis. In a January 1st post on X, Millis highlighted the rare streak and attached a chart showing Strategy's monthly returns since 2020. The data show the stock posted uninterrupted losses from July through December 2025, including declines of 16.78% in August, 16.36% in October, 34.26% in November, and a further 14.24% drop in December. While Strategy has experienced steeper single-month losses in the past, the chart shows those drawdowns were typically punctuated by sharp rebound months. During the 2022 bear market, for instance, large declines were followed by rallies of more than 40% within a few months. The absence of any comparable relief rally in the second half of 2025 marks a break from that historical pattern, suggesting a more persistent repricing rather than a short-lived sell-off. Strategy shares closed December 31st at $151.95, down 2.35% on the day, according to Google Finance. The stock is down 11.36% over the past month, 59.3% over 6 months and 49.35% over the past year. Bitcoin has held up better over comparable periods. According to CoinDesk data, Bitcoin was trading at $87,879 as of noon Eastern Time on January 1st, up 0.38% over the past 24 hours. The flagship cryptocurrency is down 5.06% over the past month, 27.36% over the past 3 months and 9.65% over the past year. The divergence has emerged even as Strategy continued to add to its Bitcoin holdings. On December 29, Executive Chairman Michael Saylor announced on X that the firm had acquired 1,229 Bitcoin for approximately $108.8 million. As of December 28, Strategy held 672,497 Bitcoin acquired for roughly $50.44 billion, he said. Strategy's equity performance also lagged the broader market. The Nasdaq 100 index, of which the company is a constituent, rose 20.17% in 2025. How crypto's promised year-end fireworks turned into a bloodbath. Digital asset treasuries, altcoin ETFs, and Bitcoin's famed year-end seasonality were meant to supercharge prices. What came instead was the worst drawdown since 2022's crypto winter. By Christian Sandor. Crypto was supposed to go out with a bang this year. Heading into the fourth quarter, Bitcoin was riding a wave of strong ETF inflows, digital asset treasuries, DATs, pitching themselves as leveraged bets on the next leg higher, and analysts dusting off charts showing the year's final 3 months as crypto's most reliable winning streak. Add in the promise of looser monetary policy and a friendlier political backdrop in Washington, and many investors convinced themselves of Bitcoin heading to fresh record prices into the end of the year. Instead, here's what happened. A $19 billion liquidation cascade in October blew a hole in liquidity, spot altcoin ETFs failed to offset selling pressure, and the new crop of treasury-heavy crypto stocks have already started morphing from structural buyers into potential forced sellers. Bitcoin is down 23% since the start of October, by itself ugly performance, but even uglier considering the continued rallies in equities and precious metals. Here's how each of the big year-end catalysts went from promised flywheel to grinding headwind. The frenzy of digital asset treasuries, hastily formed publicly traded companies, mostly this year, attempting to replicate Michael Saylor's strategy, MSTR, promised a flywheel for crypto prices and steady buying pressure. After a brief bout of buying excitement in the spring though, investors quickly lost enthusiasm. Then, as crypto prices began sinking through October, the sellings in DATs really accelerated. Their stock prices plunged, with most companies falling below their net asset value, limiting their ability to issue shares and debt to raise money. At first, purchases slowed down, then they completely stopped, with only a couple exceptions. Now, DATs, instead of their initial plans to turn investor fiat currency into crypto holdings, are now beginning to use dollars to repurchase shares. The latest was former highflyer turned penny stock, Kindly MD, Naka, whose shares have fallen so low that its Bitcoin holdings are worth more than twice the company's enterprise value. The concern goes that many more could follow and possibly become forced sellers, unloading assets onto an already fragile market, turning the supposed flywheel into a tailspin, weighing on the market. As market sentiment deteriorated across the board, the long-anticipated debut of spot altcoin ETFs in the US didn't stand a chance to make an impact, despite some of them gathering commendable inflows. Solana ETFs have brought in $900 million in assets since late October, SoSoValue data shows. XRP vehicles surpassed $1 billion in net inflows in little more than a month. That strong demand, however, didn't translate to prices of the underlying tokens. SOL has plummeted to 35% since the ETF debut, while XRP is down almost 20%. ETFs of smaller altcoins, Hedera, HBR, meanwhile, saw negligible demand as risk appetite disappeared. Analysts pointed to Bitcoin's historically strong year-end run, with the fourth quarter producing the asset's strongest returns. This year is on track to hand investors a stark reminder of an old adage: past performance does not guarantee future results. Since 2013, Bitcoin's average fourth quarter return was 77%, with a median gain of 47%, CoinGlass data shows. In the past 12 years, 8 of those had positive returns, the best hit ratio among all quarters. The outliers? 2022, 2019, 2018, and 2014, deep bear markets. 2025 is well on its way to join them. Bitcoin is 23% down since the start of October. That would qualify as its worst last quarter in 7 years if Bitcoin remains at current levels. The $19 billion liquidation cascade on October 10, which sent Bitcoin crumbling from $122,500 to $107,000 in a matter of hours, with far larger percentage declines across the rest of crypto, was damaging in more ways than one. Many thought the institutionalization via ETFs would make crypto immune to this kind of drawdown, but in reality it demonstrated that a market historically dominated by speculative mania had not changed, just shifted into a new form. 2 months on, and not only did liquidity and market depth fail to recover from the sell-off, but it also knocked the confidence of investors, who are now taking a wide berth from any kind of leverage. Bitcoin effectively made a local low on November 21 at $80,500. Since then it has rallied back to relative safety after reaching a high of $94,500 on December 9. But during that period, open interest has continued to trend downwards, falling from $30 billion to $28 billion, according to Coinalyze. This shows that the recent price appreciation can be attributed to short positions closing as opposed to genuine buyer demand, a scenario unthinkable to many that got wrapped up in the Trump, ETF, and DAT narratives of 2025. Bitcoin and the broader crypto market have underperformed equities and precious metals since the October blowout. The Nasdaq Composite is up by 5.6% since October 12. Gold is up by 6.2% while Bitcoin is down by 21% over the same period. This radically poor performance signals two things. The 2025 catalysts didn't live up to expectations and the 2026 catalysts simply aren't there. At the start of the year, Trump season was in full effect. Lighter regulations around crypto and a U.S. Bitcoin strategy were being touted while spot ETF flows continued to break records. But that excitement slowly tapered off to a point now where one of the only bullish catalysts is a rate-cutting cycle that is perceived to have a positive impact on risk assets like Bitcoin. The Federal Reserve cut in September, October, and December, only for Bitcoin to shed 24% of its value since the September meeting. While Bitcoin bulls begin clutching at straws over potential bullish catalysts, agnostic traders can see the warning signs. DATs invested heavily into crypto at the top, with several of those treasury company MNAVs now falling below 1. CoinShares said in early December that the DAT bubble has, in many ways, already burst. This could lead to a major crypto market fallout as some companies may be forced to liquidate holdings into a market that lacks any kind of liquidity to deal with waves of sell pressure. Even Strategy, MSTR, CEO Feng Liu recently alluded to the company potentially selling Bitcoin if MNAV drops below 1.0, although it's worth noting that the technology company is still raising billions of dollars to purchase Bitcoin, so that remains a worst-case scenario. There is a bullish spin on all of this, as when these companies begin to wind down it is probably a good time to buy, as seen in the 2022 bear market following the collapse of Celsius, Three Arrows Capital and FTX. Bitcoin got stuck after slumping 30% from its peak. Here's why. The October flash crash exposed how fragile Bitcoin's rally had become. It also illustrated a fundamental change in how Bitcoin is perceived. By Olivier Acuna. Bitcoin's bull run in 2025 was expected to be historic, with some industry experts suggesting the largest cryptocurrency would reach highs of $180,000 to $200,000 by year-end. Historic it was. Just not the way anyone thought. It's true that Bitcoin punched to an all-time high earlier than most models projected, rising to over $126,200 on October 6. But then, 4 days later, came a flash crash that sent the market reeling, exposing just how fragile and unpredictable trading digital assets can be. Since then, Bitcoin's fallen 30% from the October record, and more than 50% below most 2025 forecasts. Far from shooting up, it dropped 6% this year, and spent most of the past 2 months stuck between $83,000 and $96,000, according to TradingView prices. October's crash caught traders off guard and wiped out months of leveraged bullishness in minutes. But it wasn't a breakdown, according to Matti Greenspan, the founder of quantum economics. It was a rebalancing and a sign of the cryptocurrency's growing acceptance by institutions. Bitcoin was repriced as a risk asset, not a revolution. The October 10th flash crash wasn't a failure of Bitcoin, Greenspan said in an interview. It was a liquidity event, triggered by macro stress, trade war fears, and crowded positioning, that exposed how forward-loaded the cycle had become. The sudden change in behavior made forecasting nearly impossible, and made some of the space's most recognizable analysts eat their words. Read more. In 2025, Bitcoin showed how spectacularly wrong price forecasts can be. As the year started, experts such Matt Hogan, Bitwise Asset Management's chief investment officer, Mike Novogratz, Galaxy Digital's CEO, Jeffrey Kendrick, Standard Chartered's global head of digital assets research and others shared optimistic forecasts. But as it comes to a close and the dust settles, the reality is entirely different. What happened? Simply put, Bitcoin's ideological roots were overtaken by its growing acceptance as an institutional asset. This shift changed how Bitcoin was traded and evaluated by sophisticated investors from traditional markets. What went wrong in 2025 is that Bitcoin quietly crossed a threshold. It stopped being a fringe, retail-driven asset and became part of the institutional macro complex, quantum economics Greenspan told CoinDesk. Once Wall Street arrived, Bitcoin began trading less on ideology and more on liquidity, positioning, and policy. With Wall Street's involvement, Bitcoin became more closely tied to macroeconomic events, which impact all asset classes. The cryptocurrency may still be pitched as a hedge against the Federal Reserve, but it's now more sensitive than ever to Fed policy. Markets came into 2025 expecting faster, deeper Fed easing, and that simply hasn't materialized, said Jason Fernandez, co-founder at Adlunam. Bitcoin, like other risk assets, is paying the price for cautious capital. In addition, October's liquidation cascade left both retail and institutional investors bruised. Derivatives-driven liquidations made for a choppy, unpredictable market where one batch triggered the next, Fernandez said. It's no surprise ETF inflows dried up. From January through October, U.S. spot Bitcoin ETFs attracted about $9.2 billion in net inflows, or around $230 million a week. But then the momentum reversed sharply. From October through December, the figures turned negative, with over $1.3 billion in net outflows, including a $650 million withdrawal in just 4 days in late December. Quantum economics Greenspan pointed to a fundamental catch-22. Bitcoin is often framed as a hedge against the Federal Reserve, yet in practice it still depends on Fed-driven liquidity. Since 2022, the Fed has been steadily withdrawing liquidity from the system, and this liquidity ultimately flows into risk assets, including Bitcoin. When that tide goes out, the upside becomes fragile, he added. This changed reality creates a conundrum for Bitcoin and crypto as a whole. Mass adoption and price rally need Wall Street's capital, but that capital is a double-edged sword. Most people assumed institutional adoption would mean Bitcoin to $1 million, faster than you can blink, said Kevin Mirko, CEO of crypto exchange CoinMetro. But now that it's institutionalized, it's being treated like any other Wall Street asset. That means it responds to fundamentals, not just belief, he said. We're seeing prices react to everything from the Bank of Japan, BOJ, ending cheap capital to political uncertainty around the Fed itself. And institutions don't like uncertainty. Then there are weekends. Bitcoin trades 24/7, but capital flows don't. Most big flows are Monday through Friday. So when the weekend hits, and leverage is high, you get cascading liquidations. However, this doesn't mean it's all doom and gloom. In fact, it's a positive shift toward higher prices, just slower than expected, according to the experts. Bitwise Hogan said he believes the general trend remains upward, it'll be messy. But the macro direction is clear. The market is driven by the collision of powerful, persistent positive forces and periodic, violent negative ones. He said, remaining optimistic despite the recent washouts. Institutional adoption, regulatory clarity, macro concerns around fiat debasement, and real-world use cases like stable coins, those are slow-moving, positive forces. They take a decade to play out. Bitcoin, traditionally seen as following a 4-year cycle tied to the regular 50% cuts in the creation of new tokens paid out to miners, is likely to create a new dynamic in 2026, he said. The old cycle drivers, halvings, interest rates, and leverage, are significantly weaker, he told CoinDesk earlier this month. Future growth will be driven by more mature, structural forces, such as institutional flows, regulatory clarity, and global asset diversification. That's why we believe Bitcoin could hit new all-time highs in 2026, even outside the traditional halving cycle. Quantum economics Greenspan perhaps summed up what's happening with Bitcoin and where it's going. This wasn't peak Bitcoin, he said. It was the moment Bitcoin officially started playing in Wall Street's pond. Bitcoin's market got calmer in 2025 thanks to yield-hungry institutional investors. The Bitcoin market has experienced a steady decline in implied volatility as institutions embraced derivatives to generate extra income. By Onkar Godbole. The Bitcoin market grew much calmer in 2025 as institutions embraced derivatives tied to the leading cryptocurrency to generate extra cash from their idle coin holdings. The calmness is evident in the consistent decline in Bitcoin's annualized 30-day implied volatility, as measured by Volmex's BVIV and Deribit's DVOL indexes. These metrics indicate expectations for price volatility over the next 4 weeks. Both indices began the year at around 70% and are ending the year near 45%, having hit a low of 35% in September. This steady downtrend stems from institutions selling call options on top of their spot market holdings to harvest yield. We, definitely, saw a structural decline in Bitcoin implied vol as more institutional money came in and was happy to harvest yield by selling upside calls, Imran Laka, founder of Options Insights, said on X. Options are contracts giving buyers the right, but not the obligation, to buy or sell an asset like Bitcoin at a set price by a deadline. Calls let buyers purchase the asset at a preset price, representing the bullish bet on the market, while puts let them sell. Selling options resembles vending lottery tickets. You collect an upfront premium as the seller, which caps your max profit if the option expires worthless. Most options do expire worthless, favoring sellers over time. Institutions with deep pockets holding Bitcoin or spot Bitcoin ETFs have been cashing in on this setup by selling out-of-the-money calls, those higher strike bullish bets where Bitcoin would need a big rally to pay off. It helped them pocket the premium received up front as an easy yield, especially during periods of dull price action. This flood of covered call selling by institutions has created a steady supply of options, driving down implied volatility. More than 12.5% of all mined Bitcoin now sits in ETFs plus treasuries. Since these holdings generate no native yield, call overriding emerged as the dominant flow throughout 2025, driving steady pressure on for from the supply side, Jake Ostrowski's, head of over-the-counter desk at Wintermute, said in a note to CoinDesk. Institutional adoption has reshaped Bitcoin options trading in a big way, pulling Bitcoin closer to how traditional markets behave. For most of 2025, Bitcoin puts, bearish bets for hedging downside, traded at a persistent premium to calls across short and long-term expiries. This put bias has flipped the script from prior years, when longer-dated options consistently carried bullish call skew. The shift doesn't necessarily signal bearish vibes but reflects an influx of sophisticated players who prefer to hedge their bullish bets. The pressure on upside and demand for hedging, which is typical of institutional investors, saw a steady move from call skew into put skew, which propagated across the entire term structure. A sign that real money is long and hedged. Not necessarily bearish, Laka added. Bitcoin, Ether dropped more than 22% in Q4 as December Santa rally fizzles. The market's focus is now on whether Bitcoin can maintain its support levels into the new year, as the failed rally may signal a need for a deeper market reset. By Shaurya Malva. Bitcoin and Ether ended December with little sign of the year-end burst traders often bank on, capping a quarter that shows just how fragile crypto rallies can look when liquidity thins and risk appetite slips. The so-called Santa rally never really arrived. Instead, repeated attempts by Bitcoin to reclaim key levels were sold into, while Ether and large-cap tokens followed lower. Bitcoin is on track to end December down about 22%, its worst month since December 2018, while Ether is on track to end Q4 2025 down 28.07%, according to data curated by CoinGlass. A Santa rally is the tendency for markets to rise in the final week of December and early January, driven by thin liquidity, year-end portfolio rebalancing, and upbeat holiday sentiment. That weak finish matters because crypto has historically relied on strong late-year flows to set up early cycle momentum. This time, December looked more like a positioning reset than the start of a new leg higher. With Bitcoin's fourth quarter performance turning sharply negative, the quarterly tape now reads as risk-off rather than risk-on. The contrast with precious metals has been hard to miss. Gold has pushed to fresh records on rate cut expectations and geopolitical stress, while silver has surged and platinum has also hit new highs, as previously reported by CoinDesk. Gold has benefited from steady central bank demand and rising ETF allocations, reinforcing its role as a reserve-style hedge when investors are uneasy. Bitcoin, by comparison, has traded more like a high-beta asset. Even when the macro backdrop points toward easier policy, Bitcoin has struggled to hold gains without a broader bid for risk. The pattern has become familiar in late 2025, where bounces have been met by fast profit-taking, leverage has been reduced during the holidays, and U.S. hours have tended to see the heaviest selling as funds clean up positions. Volatile yields and a choppy dollar have kept investors in capital preservation mode, a setup that tends to favor gold first and speculative assets later. The first test will be whether Bitcoin can hold its recent support zones into the new year. If it cannot, the failed Santa rally may be remembered as an early warning that the market still needs a deeper reset before the next sustained run. David Beckham-backed Prenetics ditches Bitcoin purchase. The health sciences company, co-founded by English football icon, announcement comes as the crypto's market capitalization continues to lose ground. By Olivier Acuna. Prenetics, PRE, a health sciences company that raised $48 million earlier this year, partially to build a Bitcoin treasury, said it decided to stop purchasing Bitcoin amid prolonged weakness in the cryptocurrency market. The company rolled out its Bitcoin accumulation strategy in June, following a model championed by Michael Saylor's Strategy Inc., in which firms raise capital to buy and hold crypto on their balance sheets. The business model gained traction earlier this year as crypto prices rose, but enthusiasm faded after the steep market downturn in October. On October 27, Prenetics CEO and co-founder Danny Young announced the funding round, which included investors such as Kraken, Exodus, EXOD, GPTX, and American Ventures. He said the funds would help its IM8 business scale globally while accumulating 1 Bitcoin daily toward a goal of $1 billion in revenue and Bitcoin within 5 years. However, the firm said in a statement on Tuesday that it stopped purchasing Bitcoin on December 4 to focus its resources exclusively on IM8, which it said has generated more than $100 million in annualized recurring revenue, ARR, since it launched 11 months ago. The phenomenal success of IM8 has exceeded all expectations and scaled much faster than we originally anticipated, Young said. Our board and management team unanimously agreed that the most promising path to creating significant, sustainable shareholder value is to devote our undivided attention to this opportunity clearly visible in IM8. Prenetics, backed and co-founded by English football icon David Beckham, said it won't allocate any existing or new capital for the purpose of buying additional Bitcoin. However, it still plans to hold its existing 510 Bitcoin as a reserve asset, worth nearly $45 million as of Tuesday afternoon ET. Prenetics shares have risen 189% this year, while Michael Saylor's MSTR fell nearly 48% and Bitcoin dipped about 5.6%. Read more. Is the Bitcoin digital asset treasury model broken? Architect Partners says no. Bitcoin rises above $89,000, showing rare gain in U.S. trading. Open interest data suggests the advance is likely short covering, rather than fresh longs entering the market. By Helene Braun. Crypto prices kicked off the U.S. trading day with a modest rally, with Bitcoin retaking the $89,000 level after having dropped to $87,000 one day ago. Bitcoin being higher during U.S. market hours is a notable shift after the past month in which prices have seemingly dropped every single day during the U.S. session. Indeed, Bitcoin has seen about a 20% cumulative decline during the American trading day over the last 30 days, according to Velo data. As for Wednesday's small advance, CoinGlass data shows Bitcoin open interest denominated in Bitcoin has fallen since the U.S. market opened, dropping from 514,000 Bitcoin to 511,000. This decline in open interest alongside rising price action points to short positions being closed rather than new leveraged longs being added. Crypto-related stocks like Coinbase, Coin, Robinhood, Hood, and Circle, CRCL, were all little changed, as were the broader S&P 500 and Nasdaq. Year-end de-risking, record ETF outflows, and thin holiday liquidity are keeping the market subdued, according to Wintermute strategist Jasper de Meer. All three major crypto assets remain below key systematic levels, with price action largely driven by rollover flows and tax-related positioning, he continued. Spot Bitcoin ETFs saw $19.3 million in net outflows on Monday, marking the seventh straight day of redemptions. In mid-December alone, $1.29 billion was pulled from Bitcoin funds, led by a $157 million single-day outflow from BlackRock's IBIT, according to de Meer. While IBIT has recorded $25 billion in inflows year-to-date, he said December's risk-off rotation may reflect tax loss harvesting. He added that altcoins, largely outside the IRS's wash sale rules, have not shown the same selling pressure. On the derivatives side, over $27 billion in Bitcoin and Ethereum options expired on December 26 in the largest single-day expiry in crypto history, according to Deribit data. Funding rates and open interest, which peaked at $70 billion in June, have steadily declined into year-end. Bitcoin's 7-day realized volatility fell sharply into December 25, but has started to pick up, driven by erratic intraday swings. De Meer advised traders to avoid overfitting short-dated signals until institutional flows return in early January. In 2025, Bitcoin showed how spectacularly wrong price forecasts can be. Analysts aimed high. The market declined to follow. By Olivier Acuna. 2025 is drawing to an end with few crypto market stories more dramatic than the October 10 flash crash, when Bitcoin plunged $12,000, or nearly 10%, in minutes. The meltdown triggered more than $19 billion in liquidations in just 24 hours, followed by a trader-circulated cascade warning and a staggering $500 billion wiped from total crypto market capitalization. That set the scene for an extended slide that's seen the largest cryptocurrency drop to more than 30% below the peak $126,223 value it set just 6 days earlier. This painful drop is likely to leave it posting the first full-year loss since the crypto winter of 2022. The year began on a more optimistic note, with Bitcoin price predictions ranging from dreamlike fantasies to more conservative targets that, at times, seemed within reach. Then it all changed after the October 10 crash. Many predictions, from seasoned analysts to outspoken evangelists, shared one thing in common: they didn't age well. Let's leave aside the long-term forecasts that soared as high as $1 billion by 2038 from Jurrien Timmer, Fidelity's global head of macro, or the undated $700,000 if institutional adoption reached scale from BlackRock CEO Larry Fink. Even the more restrained estimates now seem somewhat overblown. Some forecasts weren't just bullish, they were explosive. Samson Mow, CEO of Bitcoin technology company January 3, predicted in February that Bitcoin would reach $1 million by the end of 2025 in a violent upward move fueled by the collapse of fiat currencies. He received support from Blockstream CEO and founder Adam Back, arguably one of the most respected personalities in Bitcoin, who, in April, also reportedly said he believed Bitcoin could reach $500,000 to $1 million by end 2025. His bullish thesis was driven by ETF inflows, institutional buying and limited supply. He wasn't the only one. Venture capitalist Chamath Palihapitiya also forecast $500,000 by October. Even some of the more conservative estimates for the year-end price target surpassed the all-time high. Among them were JP Morgan analysts, who in early October, before the crash, raised their year-end forecast to $165,000, basing it on a growing embrace of the debasement trade, a rise in investor demand for alternative stores of value. Even after the crash, Michael Saylor, the executive chairman of Bitcoin Treasury Company Strategy, MSTR, helped keep bulls' hopes alive with his October 28 expectation that Bitcoin would be about $150,000 by the end of this year. Strategy, the holder of the most Bitcoin among publicly traded companies, bought another $1 billion of Bitcoin on December 15, increasing its total holdings to 671,268. Of course, they weren't alone. Throughout 2025, a flood of price predictions poured in from across the crypto landscape, most of which serve only as reminders of just how hard forecasting can be. There was the forecast for a first-quarter peak of $180,000 from VanEck's digital asset research team, more than $50,000 above the actual high. Bitwise CIO Matt Hogan had said Bitcoin would reach $200,000 in 2025, backed by what he called the most bullish setup in years. Tom Lee of Fundstrat Global Advisors repeated his $200,000 to $250,000 forecast well into October. Arthur Hayes, co-founder of BitMEX, said he was sticking with a similar range as late as November. Only a handful adjusted their expectations downward in time. Galaxy Digital CEO Mike Novogratz, once a $500,000 prophet, was one of the few to publicly dial it back, saying in October that Bitcoin would likely end the year between $120,000 and $125,000. Standard Chartered followed suit in December, slashing its target to $100,000 from $200,000. In the end, 2025 reminded the market of an old truth: Bitcoin humbles everyone. It shrugs off models, breaks charts, and ignores even the boldest calls. Some missed by inches. Others missed by miles. But nearly all missed. As the dust settles, the industry is once again left with charts to redraw, narratives to rewrite, and a single, undeniable takeaway: in crypto, predictions are easy to make. Being right is rare. Long-term holders turn net accumulators, easing a major Bitcoin headwind. During this current correction, long-term holders have sold over 1 million Bitcoin, the largest sell pressure event from this cohort since 2019. By James Van. Long-term holders, LTH, of Bitcoin have shifted back into accumulation for the first time since July. LTHs, defined as entities that have held Bitcoin for at least 155 days, have accumulated roughly 33,000 Bitcoin on a 30-day net basis, according to on-chain data analysts CheckOnChain. Selling from LTHs has been one of the largest sources of sell pressure this year, along with miner capitulation. LTHs were a major source of distribution, while miners are typically forced to sell Bitcoin while mining at a loss. Since it takes 155 days for short-term holders to transition into long-term holders, this suggests that buyers from the past 6 months are now becoming long-term holders and are outpacing the distribution. LTHs sold more than 1 million Bitcoin during the 36% correction from October, marking the largest sell pressure event from this cohort since 2019, a period that ultimately coincided with the bear market low that year, with Bitcoin at around $3,200. The October sell-off was the third LTH distribution phase since the current cycle began in 2023. The first occurred in March 2024 when Bitcoin reached $73,000 and over 700,000 Bitcoin were sold, while the second took place that November when Bitcoin reached $100,000 and more than 750,000 Bitcoin were distributed by LTHs. Thanks a lot for tuning in to BlockSonic today. We'll see you in the next live session with more news, analysis, and market alerts. Until then, keep your eyes on Bitcoin and keep listening to the sound of the blockchain.